A cautionary tale for US stock investors. Get ready for a potential shake-up in the US stock market, as Bank of America's strategists, led by Michael Hartnett, have a bold prediction. They believe that the recent record-breaking rally could be short-lived, and here's why. The dovish dilemma. If the Federal Reserve sends out dovish signals at the upcoming Jackson Hole Economic Symposium, it could spell trouble for US stocks. But what does dovish mean? And why is it controversial? In simple terms, a dovish stance suggests that the Fed might lower interest rates to stimulate the economy. This approach is often favored when the labor market shows signs of weakness, as it can provide a much-needed boost. However, it's a delicate balance, and here's where it gets interesting. The risky business. Investors eager for gettier have been pouring into various risky assets. From equities to cryptocurrencies and corporate bonds, they're taking a chance on these markets, hoping for a Fed-induced rally. But here's the catch. This strategy assumes that the Fed will indeed lower rates, and that's not a guarantee. A flocking phenomenon. Hartnett's team highlights an intriguing phenomenon. Investors, it seems, have been flocking to these assets, driven by optimism and the expectation of a rate cut. It's a risky move, as it relies heavily on the Fed's next move. And this is the part most people miss. The potential consequences of a different Fed decision. The impact on US stocks. If the Fed decides to maintain its current stance or even hints at a more hawkish approach, US stocks could take a hit. The recent rally might be short-lived, and investors could find themselves in a tricky situation. It's a high-stakes game, and the outcome is far from certain. A controversial interpretation. Here's where things get controversial. Some might argue that a dovish Fed could be exactly what the market needs. After all, a rate cut could provide a much-needed stimulus. But others might caution against relying too heavily on Fed intervention, especially when it comes to risky assets. Your thoughts? So what do you think? Is Hartnett's prediction a cautionary tale or an overly pessimistic view? Should investors be cautious or embrace the potential upside? We'd love to hear your thoughts in the comments. This debate is sure to spark some interesting discussions.